Welcome to my continuing discussions on deferred tax concepts. In my last podcast, I did an introduction to the whole concept, and I used a deferred tax liability to show you an example and help you understand why we have deferred tax assets and liability accounts. I have a goal in this pincast as well. My goal is to review a simple example of a deferred tax asset with you and show you how that's used to correctly calculate a current period's income tax calculation. Once again, it always comes down to pre-tax accounting income. Wow, I can't spell today. Pre-tax accounting income on your financial statements that you've calculated using generally accepted accounting principles, and how that's going to differ from what you show as taxable income on your tax return 1120. In our example, let's say we still have $10,000 of pre-tax accounting income, but that our current taxable income is $10,500. The difference you can readily see is $500, and this time, let's say, it comes about in the calculation of a warranty tax expense and liability. Let's assume that for our company involved, we had $10,000 of pre-tax accounting income, and from that, we made an entry to estimate what warranty expense and estimated warranty liabilities would be. We offer a warranty to our products, and so we match the cost of that warranty in the period we picked up the revenue. That means we took out $5,000 when we calculated our $10,000 worth of income. Well, the IRS, who is much closer to a cash basis than they are an accrual basis, would never let you deduct that $500 until you paid it. The entry that you made when you set that up was, in all likelihood, you set up a warranty expense and you created a warranty liability payable in the amount of $500. I don't see any cash going out in that entry, and neither does the IRS, so they wouldn't like that. They wouldn't allow you to deduct that $500 on your tax return. So since you took it out of your accounting income, we're going to have to put it back in, and your taxable income will be increased by that. And notice that it's a liability that set this up. Well, let's assume a 40% rate again, all the way through on this. And since we're doing really simple examples, you can still see it will end up being 40% of accounting income is tax expense. 40% of our taxes payable is going to be, I meant to say 40% of our taxable income is going to be $4,200. 40% of our warranty liability account is going to be $200. And 40% of our accounting income would be $4,000. Don't get used to that always tying like that. I'll show you some examples where it doesn't cause big changes in rate and permanent differences later on. Let's come up with our accounting entry then. Our entry to record our tax expense for the period. It would include a tax expense debit to be shown on our income statement, as we need a tax expense there. It will include a deferred tax asset. We're going to abbreviate DTA, meaning deferred tax asset, and it will show taxes payable. It's probably too soon to abbreviate, sorry. It stands for deferred tax asset. So the taxes payable is $4,200. The deferred tax asset is $200, And our tax expense is the sum of the two, or 4,000, and yes, it ties to our financial statement this time. So what we have is we subtracted some money from our pre-tax accounting income in accordance with GAAP, and we put that back in and paid taxes on it. So in a sense, we have already paid taxes on that warranty tax expense. Hence, it's an asset, a deferred tax asset, the amount of taxes we've paid. Consider our financial statement again, assets, liabilities, and stockholders' equity. Now we have on our books a $500 warranty liability set up. And we show a deferred tax asset. The tax consequence of that on the books is always already having been paid. As you may have started to notice, when we set up an asset, it creates a deferred tax liability. When we set up a liability, it creates a deferred tax asset, because they're always going to offset. So this then is an entry that shows you how to calculate tax expense for the period. And the deferred tax asset helps us get to the right tax expense. Our taxes payable was $4,200, but for income statement it only should be $4,000. We've already taken that expense. There are some things I want you to note as we move on about deferred tax assets. I better take a chance and write that out since I didn't last time. So we're looking at a deferred, I spelled that wrong, that's so cute, D-E-F-E-R-R, a deferred tax asset is also referred to as a future deductible item. Notice that we added it in to our taxable income as it originates, and in the future we're going to be able to deduct it. So our deferred tax liability was future taxable, and our deferred tax assets future deductible. The second thing I want you to notice, that just like our deferred tax liability can come about from a revenue and expense, some kind of deferred tax asset. All the originating entry has to do is create a liability that's not deductible on our tax return. An example of revenue would be an unearned revenue. If you get someone who pays you money in advance, we set up an unearned, which is a liability. You get the cash, you credit an unearned. IRS is very close to cash basis, so because you've already received the cash, you would have to pay taxes on that. So you would be adding it into taxable income. That's an example how an unearned revenue can kick on a deferred tax asset. And the same for an expense. If you accrue an expense and set up any kind of payable from it, utilities payable, salaries payable, interest payable, that's not allowed on your tax return because it's payable. You haven't paid it yet. So we'd be adding those back in too. You can't really memorize if something's going to be added in or subtracted out by if it's an expense or a revenue. You really have to understand, did the originating entry create a liability? If it did, then it's a deferred tax asset. If the originating entry created an asset, then it sets up a deferred tax liability. They always net. Finally, we recognize only temporary differences. If something is going to reverse in future periods, it needs to have a deferred tax asset or liability set up on it. If it's a permanent difference, then it would not. Lastly, I'll say a deferred tax asset can come into being in 1 year. It can get bigger the next year. It can shrink. It can have a component that grows and shrinks, and you'll have the net effect changing it. But But eventually it's going to get consumed, or another way to say that is eventually it's going to get completely reversed out. Otherwise it would be a permanent difference and we wouldn't recognize those. Thanks for joining me for my discussion on deferred tax assets.